All right, let's get right into it. Welcome to today's explainer, where we're going to completely transform how you view and build long-term financial security. We've pulled together some of the absolute best insights from top financial experts, entrepreneurs, and investors to build a practical, step-by-step roadmap for your money. If you've ever felt like true financial freedom is a total mystery, or if you're just looking to seriously optimize the cash you already have, you are in the exactly right place. So let's jump in. Here's a quick look at our roadmap for today. We'll start by redefining true wealth, then look at rewiring your money mindset, the ultimate wealth formula, maximizing your earning potential, and finally, the power of investing. We're going chronologically, from the deep internal psychology of money all the way down to the hard, actionable investing math. Section 1. Redefining true wealth and shifting our ultimate financial goals. Right out of the gate, we need to completely toss out what society has told us about getting rich. We usually picture wealth as luxury cars, massive houses, and designer clothes. But actual, true wealth? It's something entirely different. Entrepreneur Scott Galloway drops this brilliant truth bomb that completely reframes our baseline goal. Think about it like this. A hotshot investment banker making $3 million a year, but spending literally all of it on a Hamptons house and a luxury lifestyle, that person is stressed out, not wealthy. On the flip side, someone making $52,000 a year but living simply and saving a good chunk of it, they're actually wealthy. The whole game is just creating a lifestyle where your passive income easily covers your expenses. Finance expert Nisha Shah makes a really fascinating point here about the trap of financial success versus true financial happiness. Society's version of success is all about status and showing off. It's an endless treadmill. But financial happiness, that intrinsic definition, that only happens when you align your spending with your actual values, not someone else's expectations. Peace of mind is the ultimate currency, folks. Moving right along to Section 2, rewiring your money mindset from scarcity to abundance. Now that we know what the real goal looks like, let's talk about how our internal psychology dictates our financial reality. You just can't build a structurally sound financial house on a crumbling mental foundation. This is exactly why so many people get stuck. As Lewis Howes points out, if you grew up believing that making money is inherently bad, or maybe that wealthy people only get rich by taking advantage of others, you're going to subconsciously self-sabotage. Those deep-rooted beliefs literally blind you. They will actively prevent you from recognizing and seizing real growth opportunities. You have to practice gratitude and start viewing money as a tool for generosity, not a necessary evil. Of course, even with the best mindset in the world, everything around us is designed to make us spend money. To break free from those frictionless, one-click spending habits that quietly bleed our accounts dry, Nisha Shah suggests inserting a forced intentional pause before every single purchase. Just ask yourself this one grounding question: do I really need it? Now, if you answered yes to that first question, hold on, you're not off the hook just yet. You have to pass the follow-ups. Can I live with less of it? And can I get the exact same thing for cheaper? This super simple 3-question checklist is incredibly effective for conquering those impulse buys that derail our budgets. It just puts the friction back into the buying process. Section 3, the ultimate wealth formula, the mathematical blueprint for your money. Okay, so we've rewired our brains to stop the unnecessary outflow. Now we can finally dive into the concrete math of managing what we actually keep. This is where theory becomes real-world mechanics. Jaspreet Singh breaks down this wealth equation, and it leads to a huge realization. That margin you have left over, your income minus your expenses, it isn't just fun money for a shopping spree. That is the lifeblood of your wealth, and it has to be split intentionally into 2 things: a cash safety cushion, which is your savings, and active investments that put your money to work buying equity. So how do you actually apply that formula day to day without feeling completely miserable? Well, Nisha Shah offers this wildly practical percentage breakdown for your take-home pay. 65% covers the fundamentals. 25% goes straight to fun because, hey, you have to enjoy the life you're building. And the remaining 10%? That is legally mandated to pay your future you. By putting that 10% on autopilot, you never even have to think about it. Now, if you're sitting there feeling totally overwhelmed and starting from zero, don't panic. Just follow this exact gamified order of operations for the next 6 months. Step 1, save a $2,000 cushion. Vanguard research actually shows that just having this small buffer dramatically reduces financial anxiety. Step 2, aggressively attack any debt with an interest rate above 8%, like credit cards. Only after that's done do you move to Step 3 and start aggressively investing. This gets you instantly back in control.
Section 4, maximizing your earning potential, and why you absolutely must grow the pie. Once your budget is dialed in, we hit a massive pivot point in this explainer. Because here's the harsh truth. Budgeting alone is not going to make you wealthy. There are only so many coupons you can cut.
Just look at this comparison. Saving money has a hard mathematical ceiling. You can only cut your expenses down to zero. But as Jaspreet Singh points out, earning money, upgrading your skills to command a higher income, that has a literal unbounded limit. The value you can create in the world is infinite. We have to stop just trying to squeeze the pie and figure out how to bake a bigger pie. So how exactly do we grow that pie? Entrepreneur Cody Sanchez has an awesome approach. Instead of taking on crazy, risky debt to start a brand new company, exponentially increase your earning power by trading your proven skills for equity. For example, if you're great at marketing, go find a local business that's struggling with sales and just offer to boost their revenue for a percentage of the upside. You don't need a fancy degree. You just have to solve problems. Which brings us to Section 5, the power of investing, making your money work for you. We've increased our income, we've widened our margins, so let's dive into the final, absolute must-do step so we don't have to grind away at work forever. Here's a scary fact. If you keep all your money sitting in a regular cash savings account, you are actively losing wealth to the rising cost of living. Inflation is literally eating it. You cannot save your way to retirement. We absolutely have to leverage the compound growth of the stock market so our money is working for us while we sleep. But don't try to guess the next Tesla or Amazon. Seriously, even highly paid Wall Street analysts fail spectacularly at that. Nisha Shah reminds us that right before the 2008 financial crash, top experts actually gave Lehman Brothers a buy rating. If the experts failed that badly at picking individual stocks, we definitely shouldn't try. The safest, most reliable wealth-building method is buying a broad index fund. You instantly get diversified across hundreds of top companies. Easy, simple, and effective. But look, there is a catch here, and it's a big one. The stock market jumps up and down year to year. So the number 5 is the absolute minimum amount of years you should leave your invested money untouched. If you need cash in 2 years for a house down payment, do not put it in the market. You need at least 5, but ideally 10 to 20 years to safely ride out the crazy volatility and capture those historical returns of 8 to 10%. Let's wrap this up with our final concept, which beautifully ties together our ultimate financial philosophy. Legendary investor Howard Marks points to a Japanese concept called mujo. It translates to the inevitability of unpredictable and uncontrollable change. We are never going to perfectly predict the economy, inflation, or the stock market tomorrow, but we can absolutely bank on the fact that things will change. Since change is literally the only guarantee we have, building this kind of financial resilience is your ultimate safety net. It's what lets you sleep peacefully at night no matter what the headlines say. Getting your mindset right, managing that budget, and consistently investing, it isn't some flashy get-rich-quick scheme. It is about building a completely unshakable foundation to handle whatever wild curveballs life throws your way. So to start building that foundation today, I want to leave you with this. What is one frictionless spending habit you can cut out right this second to start funding your future you? Thanks for joining me on this explainer, and keep building.